All right, everybody, welcome to Training Thursday. My name is Patrick France, senior instructor here at VectorVest, taking over for Glenn Tompkins. So if you guys were expecting Glenn, sorry, but he is out for the day. So I will be your host for today's session. Hopefully you guys are doing well. If you guys can hear me out there, let's get it started. Let's see those VV Nations flying in the chat. Good morning, Jay. Good morning, Sunny. Or good afternoon, Jay, Sunny, Kirby, Drew. Hopefully you guys are doing well. Hopefully you guys are having a good day. Kirby coming in saying Steve shorting BYND has me up 26% since the 29th of August. Well done, Kirby. Glad to hear it. Claude, good afternoon. Greg, hello. Hopefully you're doing well. Roger, VV Nation, glad to have you here today. We should be live both on Facebook and on YouTube right now, so everything looks to be running smoothly here. No Glenn, no Glenn. I'm the better version of Glenn, if you will. So you're lucky to have me here today. I know you guys are probably getting tired of seeing Glenn all the time, so I'm here now with you twice today instead of myself in the morning and Glenn in the afternoon. So hopefully you guys are doing well. I'm not gonna sing for you guys, unfortunately, so that will be one thing that you guys miss out on is the singing. But hopefully we can fill that with other great content here for you. All right. So once again, welcome to Training Thursdays. We're going to be talking about what headlines are really impacting the markets. Really talk about, yesterday we had the big Fed announcement. They're continuing to raise interest rates. Rates are rising. Markets are falling. And we're going to be taking a look at the headlines and taking a look at the market and see how it's being impacted based off of the new news that rates continue to increase at a rate of 0.75% or 75 basis points. So right now we take a look at the overall market. The color guard starting off in the upper left. The market timing gauge is pointing 3 ticks into the red. So the color guard is bearish and VectorVest does not advocate buying any stocks at this time. We take a look at the color guard right below it where the top row of lights are color guard or where the market timing gauge gets its colors from. Really just quickly breaking it down. Since we have those 3 red lights across the board, that tells us the price of the VectorVest composite or that arithmetic indexed average of 9,200 stocks out there, the RT and the buy to sell ratio are all moving lower day over day and week over week. So earlier we were looking at it during our mobile coaching stream, looking at the buy to sell ratio. It has continued to worsen, not very much, but then again, it's at an extremely low level. So therefore it can't really go down too much more, but down to 0.1. MTI currently staying the same as where we were at earlier this morning at a reading of 0.51. As we always talk about here at VectorVest, there's a saying that we like to say, keep your eye on the MTI. When the MTI gets to a reading of 0.6 or below, historically that's shown that the market's starting to look for a bottom. So we're at that point where we can start looking for that bottom. So keep your eyes peeled on the color guard as we go forward in this market. Taking a look at the major indices, the Dow is down about 0.1%, Nasdaq's down 1.25%, S&P 500 is down 0.6%, VectorVest Composite down 1.44% so far. Hey Ramon, hopefully you're doing well coming in from the Facebook side. Glad to see you guys here. Let me make sure got all those comments so perfect. Thank you guys. Thank you Boston for being there as well in the background. Appreciate it. Didn't Glenn get the memo? No days off. I know, right? That's how we do it here. I have a margin call on QQQ at 300 to share how to modify this trade. Jay, unfortunately, not going to be covering that here today. You can give our supporter call, but I'm not going to be able to break down individual trades during our Training Thursday here. So, unfortunately, not going to be able to get to that here today. All right, just real quick, going back into the homepage, taking a look at the top RT sectors. The banking sector is down almost 0.5%. Petroleum down 0.8%. Utilities down 1/3. Steel down about 0.75%. And ETFs, which are the bullish ETFs here, down about 0.9% so far. Can we start bottom fishing now? What does the color guard say? Eugene, if ever you're questioning whether or not you should be getting into the market, always consult the market timing gauge. Right now it reads, VectorVest does not advocate buying any stocks at this time. Hopefully that answers your question. All right, taking a look at our top VST stocks, even with the markets the way they are currently, we are seeing a decent scoring so far on those, with LNG basically flat for the session. PILBF down about 0.75%. TNK up 1.4. INSW up 0.8%, and then YPF up just shy of 2% so far. Let's see. Perfect. There we go. Also took Steve's pick this morning. So far, okay. What picks did he get into this morning, Jay? Haven't had enough time to really talk with anybody here today. Too busy with all these. So getting back into it though, contra ETFs really being the best performers so far in this market. No surprise there. ETFs or contra ETFs as a whole up 2.3% so far for the session. And last but not least, do want to take a look at the advanced to declines here shown in the mini graph. Right now we're at a reading of 0.22, indicating there's about almost 5-to-1 decliners today than advances. So about 5 times as many stocks moving lower today than moving higher. But on a positive note, as we stated earlier, that does push us into extremely oversold conditions based off the BSR, also on the MTI. So therefore, tells us we should start paying closer attention to what's going on in the market and looking for that rebound as soon as possible, or whenever we finally get that signal here. Tommy's asking, what determines when to go bottom fishing? So there's a rule of thumb here that we talk about time and time again, Tommy. Historically, the first green light after a confirmed down situation is the earliest sign that we're getting to start getting back into the market. Well, since the most recent confirmed down, we've had a sea of red and yellow. We have not seen a green light in that price column of the color guard on the homepage. And that's one of the earliest signs. So one of the more aggressive signs here. Even more aggressive than that, looking at the trend, the primary wave is still in that down situation. So we have no signs that the market's starting to even remotely rebound right now, which would give us that inclination that, maybe we could take that risk to start getting back into the market. So with the sea of red here, clearly states, VectorVest doesn't advocate buying any stocks at this time. And as always, whenever that moment comes that it is the right time to be bottom fishing, in the daily color guard report that we do for you every single night, we'll cover that for you and tell you when exactly we see those signs that the market is starting to show signs of a rally, or when you should start potentially getting back into the market there. So as always, stay tuned to the color guard, the daily color guard report. I say this a lot, I feel like, but it's still a very important thing. From being an instructor here for over 11 years, one of the easiest things you can do to improve your investing and improve your accuracy in the market is watching that nightly color guard report on a daily basis. So that's the feedback, the most consistent feedback I've gotten over the last 11 plus years. Watching that nightly report can greatly improve your investing. So I can't stress it enough. All right. Let's see. Hopefully that answers your question though, Tommy. You're welcome. Mark, back once again. Brooklyn in the house. Glad to have you here today, Mark. Thank you for coming back again for a second time. All right. So with that, let's go ahead, take a look at some of the headlines that are really impacting the markets here today. So to do that, we'll go ahead and just hop into the news here. And first story that we have, talked about it yesterday for anybody who wasn't tuning in for our AMA on Wednesdays. The Fed delivered the third straight 75 basis point hike as a race to restrictive territory heats up. So, yes, markets reacted negatively right out of the gate. We saw a steep decline on all the major indices. The Dow moved, I believe it was about 350 points in a matter of 2 or 3 minutes right after that initial news. When Powell came back on to talk about things, give his insights, the market started rallying, but then he started getting into the soft landing talk and really tried to set people up for the expectations that the soft landing is most likely not going to happen. There's a lower and lower chance that a soft landing will actually happen, and, trying to prepare people that the pain you're going to be feeling is going to only get worse from here for at least the foreseeable future. With that increase of that 75 basis point hike, that has now pushed the federal funds rate to about 3.25%. So therefore, increasing it even more gave the benchmark rate rising to 4.4% in 2022, above the 3.4% forecast in June. So, getting an even grimmer look, if you will, based off of what we're seeing here. They were saying back in the middle of summer that, they expected rates to be about 3.5. I think I even saw a high of about 3.6% by the end of 2022. Well, looks like that's not enough. No surprise there. Now they're setting their new rate to 4.4% by the end of the year. So, 3.25, we still have 1.2% roughly to go. So, we could see a potential 75 basis point hike one point, and then maybe a 50 basis point hike the next. We're going to have to be patient, wait to see. But, things were looking good when he first started his question and answer session. But by the end of it, he was getting more and more hawkish, and you saw the market react accordingly. So definitely be careful in these current environments on what the Fed is seeing. Now, on a positive note, though, when you're listening to what the Fed was talking about or what Powell was saying, he did say that, he did give a glimmer of hope or a light at the end of the tunnel, saying by about 2025 will be towards the end of where, this current tightening period ends, or this current tightening cycle ends here. So, that is a positive. Markets reacted favorably on that first comment, but that came, unfortunately, at the beginning of the interview instead of towards the end. So unfortunately, the markets focus on the most recent comments and tend to forget what the first initial comments were. So what I mean by that is, the markets tended to focus on the last comments that he left off with, rather than remembering the bull or the dovish comments he was saying at the very beginning of his Q&A sessions there. Mike saying, I told Steve about KOLD this morning, really taking off. Mike, I think that's a decent look. I like that. I've added it in on our AMAs before. I've taken a few stabs at it in the Jockey Club, but yeah, KOLD, if you can withstand the volatility, I think maybe a decent play. So we'll have to wait and see how that goes. All right, so with rising interest rates, what is that going to do to the housing market? Well, KB Homes delivered a softer outlook after mixed Q3 results. So looking at it, KB Homes delivered softer guidance on Wednesday after reporting mixed fiscal third quarter results, as earnings topped estimates, but revenues fell short on estimates as home builders flagged a shortfall in deliveries and ongoing supply chain constraints likely to hurt the fourth quarter results. Well, we know that interest rates are rising. People are not buying new homes at the rate they have been over the last few years. We saw an extremely high growth rate for these stocks over the last couple of years since the pandemic started. And to assume that type of growth rate could be sustainable, really doesn't make a whole lot of sense. So, you're already setting the bar extremely high. So the only way these could potentially go, or the forecasts or estimates can go, are down currently. With that being said, while yes, they're saying the supply chain issues are an issue or are, hurting them a little bit, I don't think that's going to be the main driver behind home prices continuing to fall, or home builders continuing to see softening in their estimates and also softening in their guidance. I think, interest rates continuing to rise, the hawkish Fed is definitely going to be a bigger impact on them rather than supply chain constraints. So, this is one aspect that the Fed will hopefully fix with their interest rate hikes, is that, by cutting everybody out of the market, by making homes unattractive to want to go buy, gives these home builders some time to fix their supply chain issues, get new inventory build up, and hopefully see things continue that way. But we got to be careful. We got to be patient. And right now, with the current environment that we're in, definitely see a bigger impact on home builders going forward for the foreseeable future, at least. Getting into it, for the third quarter, earnings per share was $2.86, up from $1.60 a year ago, beating estimates of $2.66. Revenues rose 26% to $1.84 billion, but that was short of the estimate of $1.88 billion. Now, while that doesn't sound like a big deal, you have to also remember a lot of estimates that they're giving right now for earnings seasons are being revised downward, and these companies are still struggling to meet estimates or meet expectations. So while it doesn't seem like, they had that big of a miss, when you look at how their estimates were revised downward, it really shows the true weakness that we're experiencing in the housing market currently. Even some stories are coming out talking about how the housing market is already in a severe recession, based off of the amount or the lack of growth that we've seen. So yeah, it looks like the Fed, with their rising interest rates, are willing to sacrifice the housing market to try to get things under control. That's one of the unfortunate casualties to their strides forward here. Looking ahead, though, for Q4, housing revenues were guided in the range of $1.95 billion to $2.05 billion, on average selling price in the range of $503,000. If the average selling price is $530,000 and that's their expectations, we're gonna see quite a big miss probably, because I don't think housing prices are going to be able to sustain that, especially with more and more houses coming onto the market that were in forbearance or are now starting to get into foreclosure. So it's going to be interesting to see how that plays out, but we'll take a look at their stock here in a little bit. Next story we got. Another aspect of rising interest rates, gold. Gold notches unlikely win as Fed again ratchets up rates. So gold is one that is typically looked at as an inflationary hedge, if you will, or a safe haven for when inflation is high. We haven't really seen the rise in gold and silver like we have historically yet, but maybe that's a sign that we're not quite there to where we were that really drives gold prices higher. But we'll take a look at, not only gold, but we'll also take a look at silver. It just specifically talks about gold, but with gold, there's also silver that everybody talks about. If you're looking for updates on gold and silver, though, always tune into the Monday report for the daily color guard report, because we do give our long-term outlook on gold and silver by taking a look at the gold bugs index. So if you ever want to stay up to date with that, make sure, as always, tune into the Monday night daily color guard report there. All right. Really, that's about it so far on that. Gold remains vulnerable to selling pressure if inflation does not continue to ease, but it could start to stabilize now. Just a lot of expectations on, or a lot of opinions on where they see gold, giving different opinions on where their forecasts are, all of that. As we mentioned earlier today in our mobile coaching stream, charts don't lie, so we'll look at charts rather than listening to people's personal opinions. Next up, GM to close reservations for electric Hummer pickup SUV. I know you guys are used to probably hearing Glenn being, Mr. Bullish on electric vehicles or EV space. I'm bullish on EVs, but to an extent. Now, let's talk about this here, folks. A Hummer. If you guys remember the Hummers back before the 07-08 crash, when they first came out right before the very beginning, the Hummer was by far the worst possible car you could drive on the road. It wasn't fuel efficient. It was extremely heavy. It wasn't a great performer. there just wasn't really anything that really set itself apart except for the name. Well, GM, as much as I love GM because I drive a GM car, as much as I love them, they have somehow found a way to take everything that was wrong with the original H2 Hummer back in the day, right before the 07-08 crash, when, cars were selling left, right, and center before they just stopped, before all the demand basically went out of the market. They have somehow managed to take everything that was wrong in that and put it into an EV. The electric Hummer is about 9,000 pounds. Can't tow anything. It has 2 battery packs, so it takes twice as long to charge. The battery packs are absolutely massive. They're really, the only reason somebody would buy this is to say they have an electric Hummer. That is realistically about the only reason somebody would buy this. There's nothing that really separates this from anywhere else out there. It gets barely 300 miles to the range. It takes twice as long to charge. Can't tow anything. Can't really carry anything. So at least we'll give them an A for effort, but taking a look at it, somehow people are buying them. They closed the reservations because they had 90,000 reservations to buy the electric Hummer. And just like with Ford, they closed it out. Ford saw 200,000 before they closed reservations for their F-150, electric F-150. Let's see. It's like a big Power Wheels. Yeah, big Power Wheels that can't stop. Imagine trying to slam on the brakes, what your 60 to 0 stop time is on a 9,000 pound electric vehicle. Imagine the damage you're going to do not only to your brakes, but to your tires, the road, everything. Or imagine, here I have to take 77. It's the big interstate around Charlotte. I take that to work every day, and every single day to and from work, I see at least 1 to 2 accidents of people, slamming into each other because they're not paying attention, not following along with what's going on. Imagine getting hit from behind by a 9,000 pound vehicle. Yeah, it's going to be interesting to see what type of news comes out once these things start hitting the road. And there's already been one that I've seen around our area. Somebody already has one. They're already slowly coming out. But yeah, these things are a little bit scary to see. Gas guzzlers, Hummer. Exactly, Maria. It's truly a military vehicle that they tried to make for civilians for A for effort. Exactly. Probably cost $50K to replace the battery. It will probably cost at minimum, Phillips, at least $60K, because I've seen a lot of estimates coming out between $30 to $35 just to replace a Tesla battery. And if I recall correctly, the Hummer, with the battery pack it takes to power a Hummer, you could make 4 Tesla Model Cs. So you multiply that 3,600 or 36,000 estimate by 4, you're over 100,000. So 120,000. Battery lights up, put water on hot lithium. Yeah, definitely not a good thing. But yeah, so, Glenn had this lined up for today. GM has been slowly ramping up production. I mean, they look kind of cool, but yeah, it really is something you want to be extremely cautious with. Once again, A for effort, but realistically, as a owner of a truck, as somebody who likes trucks, somebody who likes SUVs, bigger cars, I'm 6'3". I like having room. I like being in a bigger seat, or when I sit in a car driving on the road, I like having room around me. So I like being in a bigger vehicle. I like the electric vehicle aspect though. I think it's great because you don't have to spend on gas. Cheaper to maintain until you get to the battery aspect of things. There's a lot of positives for it. For driving around locally, electric vehicles are great. For making long road trips, electric vehicles still have a ways to go. But when you look at these electric trucks that are coming out, they're not the capability of an actual truck yet. They're still many, many years away before electric SUVs and trucks really become a viable solution to replace gasoline vehicles or SUVs and trucks. So while they're great, still got a ways to go. Looking at it here, the number of reservations is notable because the starting price of this vehicle, which ranges between roughly $85,000 and over $110,000. Man, I couldn't imagine spending $100,000 just for the namesake. I mean, granted, people still buy Ferraris, people still buy Lamborghinis, so there is a market out there, but I couldn't imagine spending that much for a SUV that can't even tow anything and can't go more than 300 miles. And takes twice as long to charge. It's going to be interesting to see how that goes. Maybe if they have some way of reducing weight, that could definitely help out. But at 9,000 pounds, I'm going to have to pass on this one. True. That's also a very interesting aspect is, the amount of impact on the electrical grid system that we have here in the country. You're already seeing in California where they're telling people to turn off or use less electricity, try to manage their consumption, but then they're telling everybody to go into electric vehicles. You have a lot more issues if even more people start to adopt electric vehicles and everybody's trying to charge their vehicles. You're going to see a huge strain on the overall grid here. So it's going to be interesting to see how this plays out going forward. And, maybe if we can upgrade our whole infrastructure, but then again, that causes more government spending. That creates more inflation there. If I'm still alive in 2050, I'll buy an EV car, but not until. All right, prove or ban, VP. Yeah, Roger, I don't have that article offhand, but maybe if we have some time towards the end, maybe I can find it, where they actually took, a diesel truck, they took, and 2 or 3 electric vehicles or electric trucks, and they got 140 miles before the truck ran out of fuel or out of battery. So yeah, they can't get to where they want to go if you're just going on a camping trip for the weekend. Unless you're going to, right down the road, you're not going to be going anywhere to go camping, pulling it with an electric truck. All right, but getting into it, looking at it, it did talk about Ford for a little bit. GM's decision follows Ford Motors shutting down reservations for its electric F-150 Lightning after hitting roughly 200,000 units. It has also shut down reservations for electric Mustang Mach-E crossover, but has since reopened it. So I know their crossover has been pretty successful. I've seen a lot of them on the roads personally, but you still have, the F-150. F-150 looks interesting, but it's going to be interesting to see when they actually start testing them, putting a trailer on them, towing them, putting, stuff actually in the bed, and seeing what kind of performance they actually get from it. Very true, Roger. Very true. All right. When a rooftop solar panel can power it, that's also not a bad thing. All right, so S&P 500, next article, getting into it. S&P 500 history points to a sharp bounce after the Fed meeting. So I'm not sure what their definition of bounce here is with this one, but from initial looks, things don't look positive. Looking at the S&P 500, you can see a net negative, so bearish stance on the overall market after the Fed announcement yesterday. This has been a historical point where we've seen the markets rebounding in 2007, 2008, 2011, coming into 2012, 2015 when we had the oil crisis, COVID crash, and now here. So while we are right at that level that, historically has shown that the market starts to look for a rebound, we still have a lot to go, or we still have potential for the market moving even lower. And the bets seem to be betting that we're not quite at a bottom yet. So while it's talking about a bounce, as you can see, futures net positions is firmly bearish. Therefore, not really what you want to see, expecting a bounce here. Short term, we may be able to see something, but longer term, not looking so great currently. Getting into it for equity investors, sunk in gloom, the interest rate rise expected from the Federal Reserve may actually yield some relief. U.S. stock markets have been feeling the heat ahead of the Fed meeting, with the S&P 500 and NASDAQ index falling 6.2% and 7% respectively over the past 6 days, on the outside chance Jerome Powell could adopt an even more hawkish stance to combat scorching inflation. Yet if this history is any guide, market may be due for a bounce once the meeting is done and dusted. Well, as we saw at the very beginning of today, doesn't look like the market is getting that bounce that they were expecting here. Over the past 18 months, S&P 500 index has risen after 8 out of 10 Fed decisions. In the days following the Fed meeting in January, March, and June, stocks rose between 6 and 9%, having dropped sharply in the run-up. Well, looks like we're now 8 out of 11 instead of 8 out of 10. As we know, though, when we talked about it at the very beginning, our MTI and our buy to sell ratio are showing extremely oversold positions. So while, yes, we may be getting close to a bottom for a potential bounce, doesn't look like we're there quite yet. History isn't really repeating itself in the same way as we've seen in the past. So we'll take a look at the market in a little bit, though, but really, the extreme bearish positions could also prove to be a source of support for stocks. Fund managers are the most underweight in equities they've ever been, while cash levels are at their highest level on record. Once again, this could provide support, but we're not really close to that quarter change where you typically see futures contracts and hedging positions starting to be closed and then reopen for the next quarter. So we have a little bit to go before we see the big money starting to come in to rebalance their portfolios or open up their hedges or close out some of their shorts that could give some relief to the market. Still buying contras today? Not quite. We're in some interesting markets. We'll look at it here in a little bit, though. All right, so last but not least, last headlines here. U.S. mortgage interest rates reach 6.25%, highest level since October 2008. Who remembers October 2008? I know I do. But yeah, the average interest rate on the most popular U.S. home loans climbed into the highest level since October 2008. The mortgage MBA data showed on Wednesday. So rising mortgage rates are increasingly weighing on the interest rate sensitive housing sector, and the Federal Reserve pushes on with aggressive lifting borrowing costs in order to tame high inflation. So once again, as we talked about at the earlier article, if you're listening to what the Fed was saying yesterday, they have basically said they're willing to have the housing market crumble to get inflation under control. They're willing to sacrifice the housing market because the housing market had a few great years. So hopefully they saved some of that money they were making when they were selling houses for well above the asking price, because now they're going to let a lot of that go. Hopefully they had a decent nest egg saved up from those extra profits they were making, because they're going to need it if they're going to get through this alive. These types of market conditions are really, though, where you start to see who was faking it and who actually knew what they were doing and who had proper management. Right now, while the housing market is cratering or having a lot of issues, the companies that have strong management that are leading them through this are going to be the ones that make it out on the other side in a lot better situations than they're in right now. The ones that have been not really preparing for this, even though the writing was on the wall, they chose to ignore it, are going to be the ones that we see start to go away and start to come back, or come back under new management, or come back under a different name. I sold everything in 07 and bought a new truck, and maybe I should sell the last 3 assets I'm holding. Think debt free would be safe with plenty of cash. So, debt free, not a bad place to be in this current environment. One thing I will say, so last weekend I went away for the weekend, went on a little trip just right down the road. And one thing I did notice, it was the first time I've stayed in a hotel since before the pandemic started. I have noticed that from the pandemic, a lot of hotels closed down, or what they had to do is sell to a bigger chain, and everything now is owned by Hilton, Marriott, or one of the big names. So there's no just individual hotel companies. They all basically cratered and got bought out by some of the bigger names out there. Well, now the markets have started coming back. Now, the pandemic started going away. These companies are putting themselves in a lot better position. This could be the case for what's going on in the housing market. You could see a lot of consolidation because the ones that have been managing themselves properly, not overly loading themselves up with debt, are going to be the ones that have a better balance sheet, debt-free, and those are going to be the ones that are able to buy the ones that are struggling for pennies on the dollar. And that's probably what we're going to see, is a lot of consolidation over the next few years in the housing market, where you have all these different names that are no longer going to be out there. They're all going to be into just a handful of companies, the big names that are buying them up. So I expect to see this trend continue, not only from here, but going forward, just like we saw with the automakers back in 07, 08. Take GM, for example. They had GM, they had Pontiac, they had Buick, they had a lot of different names all under their one umbrella. Well, after 08, they had to readjust. They had to replan how they were going to do it. They closed some of their portions out, closed some of their smaller companies out, and then brought them all, really just consolidated to the few main areas, and that's helped them become profitable again. So we've seen all this expansion since over the last decade, and with a market crash or a recession on the horizon, we're most likely going to experience that consolidation phase for quite a while, or at least based off what the Fed was saying, up until 2025 at minimum. So it's going to be interesting, and that is definitely a trend that you guys need to be paying attention to, because there's a lot of money to be made once that consolidation really starts to take hold, and you start to see who are the big players that are buying up these businesses and consolidating them all under their one umbrella. So keep an eye on this trend as we move forward over the next year at least. Rest of the week. Yep. Glenn is off the rest of the week. Hotel. Did you take a black light to see? No, Kirby. I didn't. I trusted it. Everything seemed well. So can't really. I'm just gonna move on from that one. Lee's saying new earnings season to start soon. Can't imagine higher calls from 1 year ago. Yeah. It really doesn't make sense. With all the expansion that we've seen, all the growth that we've seen over the last year over the last 2 years, I guess at this point, since the lockdowns, it really is unsustainable. And so, yeah, of course, things aren't going to look nearly as good when you compare them to when we were having, the highest growth rate we've seen in decades. So, yeah, it's going to be interesting to see how that plays out, and we got to be patient going through the markets here. All right, so with that, let's go ahead, jump back into the software real quick. Nothing's really changed on the homepage. Jumping into our viewers section here. Here's our stocks that we have for today. We can see number one performer, DRV. We talked about it yesterday during our AMA. I like this stock. It was one that I analyzed myself. We did have somebody asking about, what is a stock that is not a 3 times leveraged contra ETF on the housing market, but a 2 times leverage, and that is SRS. So I wanted to bring this to you guys so that way you guys have that answered for you. You guys have another option for people who aren't nearly as aggressive, but you still want some exposure, still want to take a little risk, but not necessarily the 3-to-1. SRS could be another viable opportunity here. Looking at them though, as always, with an ETF, the RV and RS are always going to be pegged at 1 or neutral. So therefore, whenever analyzing an ETF, you always want to focus on the RT. As long as the RT is above 1, the ETF is favorable. If the RT is below 1, the ETF is unfavorable. Getting into KB Homes. So we talked about it. They had poor guidance going forward, softening guidance here, down 4.5%. Currently, the stock is trading at a discount, but I think we could still see even more discounts as the Fed continues to hike rates as we go forward. How long should I wait for an IPO to settle down? I'm interested in rum, but just went public Monday. Roger, regardless of what stock it is, doesn't matter whether it's an IPO or something that's been in the market for years, follow the color guard because all boats rise with the tide and all boats fall with the tide. So therefore, be careful, especially with an IPO. Give it some time. There's always going to be opportunities. Just be patient. That's the best guidance I think we could give. Nice comments about Glenn because we know he's going to watch this later on. If you want to, John, that's fine. Everybody say hi to Glenn. Also, we've got over 180 people here and only 37 likes. If you haven't already, if you enjoy Thursdays, Trending Thursdays, and you want to show support for Glenn, if you guys miss Glenn, smash that thumbs up like button or thumbs up button right below me. Doesn't cost you a thing, takes maybe a second, and it greatly helps us out with the YouTube algorithms and continues to grow the VV Nation community. So if you guys haven't done so already, take 1 second, just hit that thumbs up like button down below me. Or if you're not happy that Glenn's not here, hit the thumbs down button. That's fine with me. Just, show some love or show us some negativity, whatever you want to do. That's fine. This is Trending Thursday, so you can hit that thumbs down button if that's fine. Enter 1 for yes or 2 for no. Maybe. We'll get to some of those. All right, so KB Homes though, looking at the RV, the relative value for anybody new tuning in for the very first time is looking at the long-term potential of the stock over the next 1 to 3 years. At an RV of 1.55, this shows that the stock does have good long-term potential over the next 1 to 3 years when compared to a AAA corporate bond. The RS factor, or the relative safety, is looking at the amount of risk in the stock compared to the average stock out there. At 1.16, it is above 1, so therefore the stock has less risk associated with it compared to the average stock out there. But RT is the short-term price trend of the stock. It's cast on a scale of 0 to 2. Above 1 shows that the short-term trend of the stock is up. Below 1, short-term trend of the stock is down. Once you own a stock, the RT becomes the most important factor that you need to keep an eye on because the RT shows whether or not the stock is making you money. If the stock's RT is above 1, then that indicates that the stock is continuing to make you money. And if it's below 1, that shows us the stock is not making you money. And type in 1 into a chat if you think or if you agree that it doesn't make sense to hold on to a stock that's losing you money. Type 2 if you think that it makes sense to hold on to a stock that is losing you money. Let's see. There you go. There's your 1 and 2s, Kirby. Yep, starting to see a lot of 1s coming in. There we go. Exactly. So I was right. We all agree that it doesn't make sense to hold on to something that's losing you money. Overall, the stock is a good stock, but right now, just not the right time to have it in your portfolio. SLV, as we talked about, with ETFs, your primary focus is the relative timing. At 1.01, that shows us the short-term trend of the stock is slightly up. Preferably, I want to see the RT at 1.1 or higher. That's really where you start to see that momentum build up, or the stock not just trending sideways, but the stock actually has some momentum behind it to make you money. At 1.01, not great. better than below 1, but I would like to see that pick up to get above that level of 1.1. Looking at GLD, gold, 0.87 tells us, even with that hike that we saw with gold yesterday, gold is actually pulling back a little bit here today. RT at 0.87 tells us the short-term trend of gold is still down. Therefore, we got to be careful on this one. SPY, so we talked about S&P 500 futures or future contracts being the most bearish they've been in years. And no surprise, with an RT of 0.86, S&P 500 is steadily moving lower. Gotta love your extra tax strategy. Hurts taking a loss, but lets you play another day. Very true. All right. GM. So we had some negative news on Ford where they're taking a $1 billion loss and they blamed it on inflation. They blamed it on supply chain still. You know, we could sit here arguing for days on whether or not it's poor management or whether or not it's poor allocation of capital or whether or not supply chain issues or inflation. Regardless, they're sticking to the case that it's definitely inflation and doesn't have anything to do with poor allocation of capital. But they're taking a pretty big loss. So GM, even though they've hit their numbers of 90,000 Hummers, they're still down here today overall with the market. Comparing GM to Ford, looking at the long-term potential. Right now, Ford takes the cake with that one. Ford has better long-term potential over the next 1 to 3 years when compared to GM. Looking at the safety factor, both of them have more risk than the average stock out there, but GM has less risk associated with it than Ford currently. Looking at the timing, both of these stocks are in a downtrend. Once again, all boats rise with the tide, all boats fall with the tide. But GM is going down less than Ford. So it's the less of two evils, if you will. So right now, overall, GM is taking the lead with a VST rating of 0.91 compared to Ford's 0.89. So while GM is beating out Ford overall from, that 30,000 foot view, neither stock are really doing all that well currently, but given the overall market conditions, no stocks are really doing all that well currently. But looking at it, Ford is actually undervalued now with that big drop they had recently. General Motors looks to be about fairly valued currently. All right, so last but not least, let's go ahead, take a look at the graphs of these and give our final thoughts on them. So pulling it up, zooming out a little bit, starting off with DRV. So at DRV, now that I actually have full control and I can see the screen a lot clearer here, I can make this, or we can point this out a little bit better here. So with DRV, I'm going to use this horizontal cursor. You had a head and shoulders pattern forming. You had the left shoulder, the head, the right shoulder. You had this shoulder line right around 52.50 roughly. And then you had a off-axis or an angled neckline here. Neckline, shoulder line, excuse me. We never continued to break down below that point. Got back yesterday before the Fed announcement. We were teetering right at that neckline here, and we actually broke down below that 52.50 level. And then after the Fed announcement, though, we finally started to see it rally. So we had the breakout from that level of resistance or that neckline, or created by that neckline. The prior day, it was struggling to really show confirmation or follow through yesterday, but after the Fed announcement, we definitely got follow through. Now gapped up even higher, continuing to move. We do have the stock in overbought territory, but as we know, just because the stock is in overbought territory doesn't mean it's going to head south instantly. Just means that you need to pay closer attention to it and make sure you adjust your trading plan accordingly. You're not shooting for the 50 to 100% gain. You're shooting for, more singles rather than doubles or triples. Essentially, you're shooting to get onto first base rather than trying to hit a home run. Apparently Kathy Wood's ARC bought 120,000 shares of GM. Oh, good for her. That's all I've got to say about that one, Ron. All right. But yeah, you have this nice upward trend. MACD steadily rising in positive territory. One thing I would keep an eye on is this level of resistance right around 61.30, 61.40. That is your next target of tightening up stops. Would like to see it break right through there, but if you have a decent gain in it when the 3 and the 8 crossed over, you have a decent gain in this most recent run, look at least, locking some of that profit in around that point. If it continues to move higher, great. But if it starts showing any weakness at that level of resistance, don't hesitate to lock some of that gain in. Now, if you're worried about, how fast a 3 times leverage ETF moves, SRS is another viable candidate here for you. So very similar look to what we were seeing with DRV, but just a little less risky. Doesn't move quite as fast as what we saw with DRV. Same situation. You have the head and shoulders here. You could even claim that, this was the shoulder line here. You did break below, had a little dip, fake out. Then you started moving higher, came back quickly. But regardless, we still have a breakout from resistance here. And you have a high of around 20 where you could see some potential slowdowns or some capitulation around there. Looking at it though, volume's been fairly decent. We like seeing that. Volume is about average so far here today. KB Homes. KB Homes is exactly opposite of what you would want to see. Typically here at VectorVest, we prefer looking for stocks that are moving from bottom left to upper right. KB Homes is moving from upper left to bottom right, the wrong direction. Now, with KB Homes, you do have a potential higher low compared to the lows we hit back around the beginning of June, or around the middle of June, excuse me. But with that poor guidance going forward, with interest rates continuing to rise, poor Q3 results, we broke down right below that current support floor. Where is it? Why is it flashing here? Let's turn off. That's probably why. Of 27.39. And it doesn't look like we're trying to rebound, trying to retest it here today. MACD steadily moving lower. So therefore, if you're looking at KB Homes, what we want to see, using the extended line here, we want to see a breakout of this trend line. This is a downtrend line, and when using technical analysis or using a trend line, you need to see it break above that trend line to show a new uptrend is forming here. And right now, we clearly don't have that. Moving on to the next one, SLV. So SLV has been steadily moving lower. Once again, this could be a great opportunity for a trend line to be used, either connecting these highs here. But one of the things that's interesting to point out, while yes, SLV has been going down, looking at the MACD has been steadily rising, creating a bullish divergence. Something I talk about quite a lot from a technical standpoint. I love trading divergences, but when you see a divergence like this, just because you see it doesn't make you want to go jump right in and go buy it immediately. You wait for confirmation. So how could you play that? What is confirmation? What would you look for? A breakout above this trend line. You can see we kissed that trend line just yesterday, failed to really break above it, but still very, very close to that trend line. If we break above this downtrend, that indicates a new uptrend is starting to form, and that bullish divergence is starting to really kick in. And that's when you start to see a pretty big run to the upside from that point. So if you're following SLV, that is something to keep an eye on as we move forward here. Looking at the next one, GLD, very similar situation. Gold has been steadily declining. The MACD steadily rising or hitting higher lows. So therefore, possibly setting up for that bullish divergence. Not quite as pretty as what we were seeing with SLV, but still you can make a case, something to keep an eye on as you move forward with this one. MACD cross is a good entry point on a divergence. There you go. Different strokes for different folks. You could use a lot of different things. Candlestick patterns. You could use other technical indicators, combining it with them. Yeah, there's a lot of different things you could add or you could use, but yeah, MACD crossing is definitely a good sign. The only thing is, here on a short-term basis, MACD crossing, definitely. Maybe that's when you take half position. And if you wanted to take the full size position, wait for that trend line to be broken or wait for some other confirmation. But that way you gain a little exposure early on taking a risk, but you minimize that risk as well by only putting in half a position instead of a full position size. That could be an interesting way of managing that for 27. I like that suggestion there. All right, next one, SPY. SPY, clearly an oversold condition, but as we know, we can stay in oversold conditions for quite some time. So just because we're oversold doesn't necessarily mean that we're out of the woods. Oh man, Glenn has had a field day with this one. Let me clean this up a little bit here for everybody. I'm sorry you guys had to see this. All right, looking at SPY though. You have the summer rally, but now we're heading back down towards the same, or back down to the 2020 or 2022 lows. Taking off the extended line, looking at it here, 362.17. We're only about $13 away from hitting the all-time lows for the year. Right now, the 3 and the 8 are still negative. Volume, extremely strong bearish volume yesterday by the end of the day. MACD, while it is getting slightly thinner here, showing a slight slowdown, it still is negative and still heading even further south here. So there's no real signs of any let up in the market. Maybe temporarily, but longer term, we still have lower highs, lower lows. If we even zoom back out a little bit, let me go ahead, put this on. Here's the beginning of January. Since that point, even with that big rally that we had during the summertime, we are still hitting a longer term pattern of lower highs and lower lows. So until this longer term trend, for you longer term investors out there, until this longer term trend dissipates, I'll bolden this up so you guys can see it a little bit better. But until this longer term trend dissipates, we're not out of the woods, folks. Simple as that. It's bound to come back, right? Right? Eventually. I mean, as long as you don't put a time horizon on that comment there, Roger, you're guaranteed to be right at some point, right? But yeah, just keep an eye on that as you move forward, especially in the overall market. I know SPY is one of the most popular ETFs to trade out there. So most likely we have some people out there trading it. And if you are, keep your eye on that overall longer term trend line here. All right, getting into some stocks again, looking at GM, same situation. We'll put it back on a 6-month basis. It will come back in 2025. Hey, careful, Michael. Don't put a time horizon on a guess like that. That's the thing. That's why options are so tricky, and that's why most people end up losing money trading options who, especially if you're not familiar with them. When you put a time frame on when your bet has to come to fruition, that's what most people get wrong, is that time frame or that time horizon that they put on it. So as long as you say, the market will eventually be higher, most likely you're going to be right. Or the markets are going to be lower, eventually you're going to be right. But when you put a time frame on it, that's when you change the dynamics of that bet a lot there. All right, so looking at GM though, GM, you had this nice little run up. Summertime was good for the overall market as well. But Once again, as we've said many times already on today's stream, all boats rise with the tide, all boats fall with the tide. Looking at price moving higher, look at the overall trend on the MACD, just looking at the histogram. Slowly drifting lower, now starting to get wider to the downside. Yes, we're getting close to getting to that oversold territory based on stochastics, but as we know, we can stay in overbought and oversold territory for quite some time. Also, extremely strong selling volume on the last couple of days. And as we've said, Glenn's kind of adopted the saying, volume is conviction. What I mean by that is it shows you, that can tell you when you need to pay closer attention to certain candles. So you look at the volume, you look at, okay, here's the spike. Let's go look at the associated candle. Big red down day. Next day, big red down day. So that's a lot of selling pressure coming in, indicating that most likely the bigger money is moving to the sidelines, taking their profits, moving on. And we haven't seen any sign that big money is coming back in to reverse this trend so far. And then you have Ford. Ford losing $1 billion based off inflation, and definitely not because of poor asset allocation or capital allocation. Gap down, continuing to move lower. No real signs in sight of any potential reversal coming in. In fact, you had yesterday, you held that low from the big gap down on, what was that, Monday? Tuesday. But today, you're finally getting the follow through, more downside potential ahead. Can't really maintain that. What is that? Let's just zoom in. Oh, forgot that I had that on. Let's go ahead, zoom in here. Looking at 1308 as that new potential resistance here. All right, so that's going to wrap up our summary of those stocks that we're looking at. Once again, DRV by far one of the best performers that we've seen here. Looking at the homepage, we're still 3 ticks into the red, still about 4 to 5 times the amount of stocks moving lower than moving higher here today. But on a positive, we are finally getting to true oversold conditions. So therefore, we could potentially see a rebound in the near future, but we do need to see signs of that rebound starting to take place before ever putting our hard-earned cash into that rally. One last thing I will point out, getting into it, we talked about, I said I'd mention this, or said we'd take a look. This is something that a lot of people have been asking. Actually, I'll just do it this way. Make it more visually appealing for you, everybody out there. So when we had that most recent sell-off before this recent downturn, here, what date was that? The 9th of September. Everybody's saying, oh, market's hit a bottom. We're going higher from here. We were warning you guys not to jump in quite yet. 1, we didn't have any green lights. 2, looking at the buy to sell ratio, 0.28, MTI, 0.64. Our indicators didn't get to that oversold territory that would indicate the market is truly looking for a bottom. This is why we were saying hold off. Even with that rally up until just recently, we didn't see any green lights appearing in the color guard. So therefore, we still have not found any signs out there that, hey, we're finally starting to see a turnaround. But rest assured and sleep easy at night knowing that when we do finally get those signs, when we do finally get those first indications that we can start getting back into the market, we will point it out for you guys in that daily color guard report every single night. So if you guys want to make sure that you stay up to date and you're not a subscriber already, click on the link down in the description below of today's video. Sign up for the trial, the 99-cent trial, I believe it is. And make sure that you have the daily color guard report on your side. Just like in 07-08, where we warned our subscribers to get out of the market before the major crash. And just like March of 09, when we started saying the market was itching to rally and get ready to start getting back into the market from a longer term perspective, just like we warned everybody and kept our subscribers on the right side of things then, we will continue to do so now in the current environment. So If you want to make sure that you stay on the right side of things and you're not already a subscriber, make sure to do so right now. This is the time that VectorVest becomes more important than ever to have on your side. Also, as Maria stated, if you haven't already and you're hanging out still at this point, hit that like button. All that helps us out. Doesn't cost you a thing. And continues to grow this awesome community and continues to allow us to bring you guys this content on a weekly basis. So if you guys have enjoyed yourselves, make sure to smash that like button before you head out of here for the day. So on that, that's going to do it for me today. Thank you all for tuning in. I hope you all have enjoyed yourself. I hope I did Glenn justice and brought some fun time for the Trending Thursdays. So if you guys have enjoyed yourself, make sure to smash that like button there. So on that note, it's been my pleasure being with you guys. I hope you guys have a great rest of your trading day. Be safe out there. Be careful in the current market environments and have a great weekend as well. So until next time, take care, adios, and toodles.